Welcome to the Risk Reversal Podcast. I'm Dan Nathan. I'm joined by my friend Marko Kolanovic. He is the former Chief Market Strategist at JP Morgan, and he's my texting buddy as it comes to the markets here, because not only are you and I texting, but you are becoming a prolific tweeter. Marko, welcome back to the podcast.
Thank you, Dan.
You were last on November 15th. So we're about a week and a half outside of the election at that point. You had a lot of really interesting things to say about policy. You had a lot of really interesting things to say about concentration in the Mag 7. A lot of that stuff has played out over the last few months or so. You and I had been chatting maybe 2 weeks ago. You were not feeling particularly great about the S&P in particular, and you thought that there was risk to 5,500 in the near term. Well, Marko, last week we got down to, what was it, 5,505 or something like that. Yeah. So let's just talk. We're going to hit a whole host of things. We're going to hit politics, policy, geopolitics. We're going to talk about rotations in the S&P, but rotations out of U.S. into overseas, and basically what you see for the balance of the year. I know that's very early this year to get there. Let's talk a little bit about how you thought in the near term we were going to go from 6,100 in the S&P down to 5,500 and why we would stabilize there for a little bit.
Yeah, so I mean the move down has been pretty much a straight line, you know, like and then so first you had this concentration starting to sort of weigh down on index, you know, as people started getting out of stocks like Nvidia or Microsoft, so on and so forth, Mag 7s basically. The trigger really was the smaller speculative momentum names, you know, like, and we talk a little bit like names like a Palantir, AppLovin, HIMSS, those types. So that was the first crack, and then it kind of pulled down the big tech concentration. But it was, pretty much straight line, and somewhere, after a few days of sell-off, you then start having a pile-on of all the sort of quants, so those would be vol targeters and risk parity funds, right? When the vol goes up, they start selling, and then we broke the 200-day moving average. So then you have the CTAs who are very long, then going short, so then you have this like a technical pileup. So I was a little bit looking sort of dynamics of that technical purge, like everybody has its own models and stuff like that. But I think it was pretty much agreed that has run largely its course, and then so-called fundamentally, it's still not clear that we are going into recession, right? So there's still good number of people out there who thinks, hey, this is just a scare. This is not like this is not now basically recession, right? Like, so then you started seeing people coming in, and maybe sort of 2-3 days before the bounce, you would see attempts to bounce, a market to bounce. So, so let's say a market would kind of open up lower in the morning, and then you would see try to rally, but then in the afternoon you get again the residual of these call it call and quants, so CTA, vol targeting, risk parity, they would slam it down, but you could see some dynamics that it's kind of like a slowing down, right? And that told me sort of that once when the quant selling wears off, you will have these people will be able to lift the market a little bit at least, right? You could also see the VIX. VIX at some point kind of stalled around 30. And then we had this bounce. I'm still of a view that we are far sort of we're not out in a clear.
Yeah.
So I see it a bit more as a.
So we're recording this Monday afternoon. The S&P is up 75 basis points, and on Friday we rallied like 2.1% or so. So we're nearly 3% off the lows. We got down 10% at those lows. Talk to me a little bit about the speed in which we sold off 10%, because I've been reading this was one of the fastest 10% declines. When you look at all the data you just talked about, vol targeting and a whole host of CTAs and all that sort of, how important is the speed in which the market sold off?
So, I mean, I look at the sort of amount, sort of theoretical amount of how much needs to be sold in kind of billions of dollars, and it's a little bit of a guesswork, like everybody has a model, and, so it's not exact number, no way to know. But like I was more looking at, okay, how much kind of amount was sold. But the speed was, it is a factor. Technical analysts, they look at the sort of RSIs, they look when things get oversold. So it was in S&P, it was fairly orderly, but Nasdaq had some disorderly days. There was at like a 4% day, and and then attempt to bounce, and individual names had some pretty disorderly selling, so it's always a little bit of a guesswork, but it was pretty fast. The amount that was sold was pretty high based on these call it vol targeting models. And then, Nasdaq had that like a 4% down day, which could maybe indicate a little bit of some sort of capitulation.
Right.
S&P we never had like a S&P proper crash, but Nasdaq, I think you could say that it was almost a bit of a crash.
And that's where a lot of the euphoria was. And you mentioned, like, let's say some of those meme stocks, and you and I were talking offline a couple of weeks ago, like Palantir became a $300 billion market cap company. AppLovin became like a $200 billion. Those stocks nearly got cut in half. And, on a day like today, it's kind of interesting to me that Palantir is barely rallying right here. So for some reason, it kind of got put in this Mag 7 sort of environment where, folks were rotating out of it. So when you think of just, going back to 2021, for instance, so the Fed was late to kind of recognize inflation, not transitory. They started indicating they were raise interest rates. Some of the first stuff that got hit were basically meme stocks, were, unprofitable tech, were SPACs, was crypto, and all the whatever those meme coins and all that sort of stuff were NFTs. So this time around, it's kind of interesting because Treasury Secretary Bessent talked about how they want to target the 10-year. They're not worried about some froth coming out of the euphoric stock market. Now, I agree with that. I just don't agree that they're not worried about it. Okay. So that's one thing. And so what did you make on the last two Sundays? It was first Trump, and then it was Bessent saying that, the stock market doesn't concern them. A few weeks ago, Bessent had suggested that they're going to target the 10-year. Talk to me a little bit about this lack of worry about the stock market, because again, I don't believe that they don't care about the stock market, but tell me what you believe.
No, so I'm a little bit surprised with this message, which is very uniform across the administration, from Lutnick, Bessent, Trump, pretty much everyone there, kind of, we don't care about markets, we don't care about markets. I think it's not, it's almost you gain nothing by saying that, and you actually do lose something by saying that. So I don't understand that strategy, and you can sort of contrast the strategy that Chinese are having, right? I mean, Chinese are doing everything and anything to talk up their market, right? And what you see is basically U.S. capital going to China and the U.S. capital leaving U.S., and hey, we didn't even have these April 2nd tariffs, right? Like, so what's the point of that? Like, what's the point of sort of beating down your own market and letting that capital flee to China, right? So I don't understand the logic. It's a bit like a bravado kind of, hey, don't bother us, we really don't care, kind of, hey, you're not gonna be able to coerce to kind of twist our arm into changing policy, we don't care. You don't have to say that. You can just proceed with your tariff policy and just say nothing about market. Or frankly, you can say, I really do care about markets, and then slap like big tariffs. Yeah. Like, so I don't understand.
Well, that's logical. But so let me ask you this.
I don't understand the logic of it.
Did they start saying that once the stock market started topping out? Like that's one of the things. And I'm not saying they're watching tick by tick. They don't stare at FactSet machines like you and I do all day long. But I don't think we started to hear that until the S&P was down at least 5%. And then some of the stuff, that's why I brought up 2021. Some of that other stuff had already been correcting in a meaningful way.
Yeah, I mean, look, I think it's, in the first term, Trump was sort of always claiming it's a scorecard. It's a scorecard. He took tremendous pride when the U.S. market was outperforming Chinese market. He was kind of saying, "Hey, look at that. Where's Chinese market? Where's U.S. market?" Right. So I think kind of he brought it up on himself. Right. So he now need to sort of a little bit disassociate from that. Right. So that's why they started talking, but only, of course, look, if the market went up, I'm pretty sure he would say, hey, look, this 100%. is very successful policy. And he did start by saying this is the greatest markets or something like that. Right. So, I'm not sort of conspiracy theories, but people, I mean, the different sides of the world, different parties in this geopolitical standoff got prepared in different ways into this. Chinese clearly got prepared. I'm not, the whole DeepSeek, the whole Alibaba rally, the whole stimulus support, embracing back Jack Ma, all these things. It's not a coincidence it all happened basically at the Trump inauguration, and then you have also European, right? Like Europeans announcing this like a massive stimulus, and hence you have European stocks going up like 20%, right? And Trump was kind of like, he was first praising the markets because it was up, and then he said, hey, it's not my fault, it's Biden's fault because it's going down, and then, hey, we don't care that it goes down, right? So it seems really like geopolitical markets are a little bit geopolitical battleground here. And it's not going all that well for U.S.
Well, more so than any time I can remember in as long as I've been in the business, when you think about picking a fight with your two biggest trading partners, your three biggest trading partners, when you throw the EU in there, and three of your biggest allies, and using the EU as a block, and then finally getting around to your biggest adversary, with is China. I mean, think about how much more time and energy they've spent talking about, Mexico, Canada, and the EU. What do you make of this notion? And again, listen, I'm not an economist. I've never been a strategist like you were. And I know when you were at JP Morgan, you probably talked to hundreds of brilliant clients all over the world, and you probably had a really good sense for where sentiment was, right? But this idea that they are trying to tank our economy near term in an effort to, it's no different. And Guy and I use this analogy, you get a new CEO comes into a company, they kind of throw the kitchen sink at forward guidance, and they set the stage, so they can start beating. Do you believe that's what they are doing? Because to me, it's one thing for them not care about the stock market, because they always come back, right? It's another thing about playing chicken with the US economy and thus the global economy to get an agenda through.
So look, I think there's definitely an element of that, right? And a little bit in the defense of the administration, multiples were high. Fiscal support for market was abnormally high, right? And they were kind of dealt that card, right? And now they could either kind of try to perpetuate that, to appease the markets, or they could try to push forward with their policy, which would ultimately upset the markets and upset all the sort of, global dynamics as well, right? So they decide to kind of openly says, we don't care. We're going to kind of we're going to detox the economy, and the market, if there's a recession, kind of so be it. So they kind of bluntly, on one side, I can understand that they were dealt a pretty bad hand, right? Like a market at the top, multiple at the top, fiscal spend at the top. But then on the other hand, as I said, I don't understand why you need to, you can say, hey, look, we obviously care about capital staying in the US. We care about this company. We'll do our best. You can still do the agenda, right? But nominally, you can say that you care. So that part I don't understand, right? So maybe they realize there's going to be no way to avoid the downturn. So it's better than to have a downturn early on.
Yeah, but do you believe? I just don't believe that that's what they're doing. I just don't like for instance, Trump is kind of this low interest rate guy. Remember how he kind of browbeat Fed Chair Powell back in 2017 when they were raising interest rates in 18 and right up until the end, and I go back just thinking about 2016 when Trump won that surprise election and then took over in 17. They had a good economy. They had a stock market that was all-time highs. They had unemployment at lows. I mean, it looked a lot like here. They also had a very accommodative Fed for the most part, and there was a lot of fiscal stimulus in the market. So, to me, I don't believe that Trump cares about a budget deficit. I don't think he believes about national debt. I don't also believe that he is willing to let Scott Bessent and Lutnick take controls of the U.S. economy. You know what I'm saying? I just don't believe any of that.
I agree. I think opportunistically, he can maybe believe in what is the most convenient at the time, right? So I don't think he is a hard set on certain things. I mean, he did sort of these tariffs, and I also don't understand, right? Because every probably CEO, every probably a market indicator is telling you that it's kind of not going to work out the way, but he might not care because it maybe is politically beneficial. So clearly he's set to go forward with these tariffs. It upset the market. It's not the only thing that upsets the market. I mean, if the multiple was of S&P 15, maybe it wouldn't react this way, but multiple was high. This was a trigger. They really didn't even start properly this trade war. Market already corrected. The worst, I think, kind of egg on the face is that Europe and China rallied at the same time, right? So it's not it's not that everybody is doing worse. It's actually U.S. is doing doing poorly, and sort of that's where now and we'll see April 2nd what happen, and I don't think April 2nd magically is going to be a great global peace deal, right? So that's why even this market bounce, it's hard to have a strong conviction that it's that it's going to go through.
So you mentioned 2022 and the potential for a recession 2023. So, into that bear market, I think that the market was sniffing out a slowing economy. It was sniffing out a lot of euphoric, there was a lot of misallocated capital, we could say, across the board. And I remember you coming on Fast Money and you were pretty steadfast to that into it. You might have been a little early, right?
Early,
but a lot of stuff that you were seeing under the surface, Guy, myself, and Danny, we were talking about it every week, at least on our podcast or on Fast Money, and it led us to believe that there was going to be, a difficult return, profile ahead. So going into 2022, everyone thought there was a recession. The market acted like that. The sell-off, at least in the S&P, was very orderly for the most part. We didn't have too many panicky sort of things. But then going into 23, everyone was still convinced of a recession and then the regional banking crisis. So my question to you now is like, okay, we're not really flirting with a recession at all. You know what I mean? And so do you think a protracted trade war, is there a strong likelihood that like our allies have become emboldened, right? And who knows how long they're staying. Do you think that we could go into a recession finally? We haven't had one since 2020.
I do. And as you said, 23, we had the, Silicon Valley, we had the commercial real estate. Fed was not basically cutting at all, although they did patch the problem.
Which, by the way, the liquidity that maybe you or me or some of these other didn't anticipate.
Correct, exactly. So that was a surprise. I think Fed very forcefully backstopped it. But so there were a lot of these sort of things that look like it could tip us in recession. They didn't, right? And the reason is there was a tremendous wealth effect. All these stocks like crypto stocks, everything went up. Then basically we had a very, very big fiscal spend as well, right? And it was I guess not a time of recession. Now, why I do think the risk is now, because all of the problems are still here, right? Back then we were talking about consumer being tapped out, credit cards being maxed out, interest rates on credit cards being so high, real estate issues around interest rates, right? But it was too early, right? And we know, like, I'm surprised that real estate market got frozen for so long and nothing bad apart from that, the whole, Silicon Valley thing didn't go down. But interest rates are still high, right? So that problem persisted. Consumer basically, the whole low end of consumer, right? The one that has a lot of credit card debt and is struggling did not get better, much. And now then you have this wealth effect hit, right? And fine, maybe on S&P is 10%. On crypto is a short period of time now more. So I think it's very much also tied into that, right? If the market drops another sort of 5 to 10%, it might be really self-fulfilling. People just say, okay, we freeze and we stop spending, right? That's even before talking about tariffs, right? Yeah. That's even before that. And then you add all the sort of tariff issue whereby corporates may stop spending, right? If the corporates were like massively expanding for, be it sort of tech upgrades or hiring or any kind of CapEx, they may now say, hey, look, there's a hell lot of uncertainty, so let's just wait a bit, right? So you have that additional thing. So all the problems we had before, they're still there. Like, they didn't cause recession, but they didn't get better. And then there are some new problems. And then you have this sort of wealth effect that I think can tip the scale, right? So it's hard. It's very hard to say like, hey, I forecast recession 6 months from now. But I do think like now is probably the highest chance we have it.
Yeah. Do you think though, let's assume April 2nd, they go into place. Let's assume that now they kind of really turn their focus towards China and that goes back and forth a little bit. What are the conditions in which that consumer, holds up? Because that's the thing. So when you have this lower end consumer kind of fall out, given all the things that stacked against them, isn't some of the data suggest in the direction that, let's say, the employment market's going, consumer confidence that we had on Friday, there's some other pieces of data suggest that, the economy really hinges on that consumer, and it seems like that some of the pillars of that story are kind of being, kicked away.
They're definitely being kicked away, right? And again, sort of, going back on the wealth effect, on sort of psychology of consumer. It's also very, very sort of bifurcated. So if the surveys, like Michigan survey, like it's half of people think it's horrible, inflation is going to go through the roof.
Those are the Democrats.
Yeah, like and then half thinks actually not that bad. It's okay, and they're independent who thinks like actually things are marginally getting worse, right? So there is this also a division, but sentiment is sentiment. If people don't feel.
But that division is really interesting because I wonder how long it lasts. If we have the jobs market slow, if we have CapEx, and stuff like, kind of be tamped down, that's obviously a huge driver of growth, right? And, if you think of red states, and if you think a lot of these places or a lot of the turns that we've seen politically over the last, call it 10, 15 years, these are, folks that are not likely to benefit from a trade war. If you go back to Trump 1.0, when they put all those agricultural tariffs farmers, they took in like $60 billion and they had to give that $60 billion right to farmers, right? And if they don't do that, they're going to lose the midterms. You know what I mean? Like the Republicans could lose, the White House in 2028. And those are just obvious sorts of things. But let me ask you this, because I've never really heard this in my career from a central banker or from the Treasury, that they're more focused on fixing or working on the 10-year yield than they are worried about that sort of wealth effect that comes from the stock market and housing. Is targeting the 10-year yield trying to get the housing market unstuck a little bit?
So in theory, that could be, okay, like, if you do something that's going to upset the market from a sentiment perspective, right? Like, you could expect 10-year to drop as a little bit of risk off rotation, So maybe they're saying that, hey, look, we're going to do something that's going to upset, but hey, this is a benefit, 10 years is going to drop and it might help, might have some second order benefits, right? In terms of mortgages and so on and so forth, right? Now the problem is it's not working, right? What we saw, because basically China is responding with a massive stimulus, and Europe is responding with a massive stimulus. So like a 10-year bond shot up like 30 basis points of that announcement, right? Like, and actually 10-year US went up as well, right? So you basically have a sort of negative macro news around tariffs or geopolitically issues that we have now with Russia and Europe, and that you would expect that yields drop. Yields didn't drop. So even that
yields
benefit
have been stuck right here. They've been stuck, 425, 430.
They would be lower, I think, if there was not because you have Japan, you have China, and you have Europe, right? Like, so if all of your trading partners are gonna use fiscal measures and there is gonna be direction of their yields going up, I don't think U.S. yields in isolation are gonna drop until it's probably too late. If there's a recession, they'll go down for sure.
The 10-year is right where it was a year ago, is right where it was at the highs in 2022, and it's basically almost at the midpoint of the range if you go back to September when it was 3.6 and as high as 4.8 or so. Where do you think, all right, let's make some assumptions. Let's just say the trade war, lasts a bit longer than folks think, so there's no big deal. Let's say China continues to stimulate and their economy gets better. The Europeans, let's say they remain emboldened, but they kick up the spending and they kick in the fiscal. Where do you think the 10-year shakes out? And let's assume all of that slows the global economy, at least as it relates to the U.S., because we're the ones opposing, the tariffs. Does the 10-year, does it just stay here because that's where it's been for the last 3 years?
Exactly. Plus minus, 20 basis points, stays in this range. I think for 10-year to meaningfully go down, we either have to have a recession, basically Fed cutting, growth long-term forecast being revised lower. So you need to have that risk-off bid and maybe central bank's action for meaningfully to go down into sort of.
All right, so the risk-off bid, if you look at, in January, the 10-year kissed 4.8%. And since then, it's gone down to 4.3, like we just said. But what also went down was the stock market, which went down about 10%. Talk to me a little bit about how many times you've seen that, where yields have gone down, and that was a big move in a short period of time, and then the stock market got hit.
It used to be always like that, It used to be always like that. Like, market goes down, yields go down, right? Bonds rally
because of the flight to safety.
Correct. That was since probably 1997. And it was also conditioned on the Fed, right? Because basically market would tank, people say, oh, Fed is going to cut, so yield goes down, right? So it was almost like a muscle memory of market participants to trade it that way, right? And then things changed a little bit when the market got too much hooked up on a monetary stimulus. Then basically, QE, market's going to rally, right? Yields are going to go lower and market's going to go higher, right? So then really the opposite relationship, right? So the right sign of relationship is like basically stock markets go up, bonds go down, right? Since the whole activism of QE and where basically the economy were being propped up by central banks buying bonds, relationship flipped, right? And then came inflation, so that was another issue, right? Because if then yields go too much higher, that would kind of tank the market, So we are now in this a little bit. I think we're going back in that old regime, really, where there is a recession risk. Maybe in that case, inflation is not going to go through the roof, right? And then Fed might, Fed is more likely to cut the rates, right? If there are problems, right? So if there are problems, market will go down, Fed is more likely to cut. Again, so I think we're back in that old school regime, which was the regime.
All right, well, let's talk about this. So if, again, this goes back to the stimulus that's happening outside the U.S. Let's say China starts to stimulate. Their economy's been so bad for so long. Okay, let's say the Europeans keep spending. Aren't we likely to see inflation kick back up a little bit? Because then if you put the trade and tariffs in there too, then you say to yourself, well, crude oil at 68, maybe it goes back to 80. Maybe like a lot of prices of eggs never go down and stuff like that.
I think there's going to be that stagflationary risk, right? So I don't think we will go into hyperinflation, right? But I think it's going to be basically inflation is kind of stubbornly high, while actually economy is slowing down, but ultimately, if economy is to really slow down, I think rates will go down and inflation will, go to zero, perhaps.
It's funny, Tom Lee of Fundstrat, he was on the pod a few weeks ago, and he said actually tariffs and trade war could actually be deflationary, and I didn't understand it at the time, but the whole notion was that if you have, slowing growth, then you have folks who are going to, kind of pull back on spending, whether it's consumers, whether it's companies. The risk there again is that things go, horribly wrong in a pace in which that a lot of folks didn't expect, and then it becomes that much harder. Does that make some sense? Or no?
It does, but I don't think it's a good thing, right? I think for trade war and tariffs to become deflationary, that means actually things are really bad for stocks,
which has been which was the case for China over the last few years, right? So let's talk. We haven't talked about the dollar yet. So the dollar sold off fairly significantly over the last, call it, month and a half or so, almost 2 months. The Dixie was at 110, and right now it's trading at 103.5. And this was a point I kind of made on Fast Money. It was like a few weeks ago before the market really topped out, and everyone was pretty bearish, and that's great on the desk, ahead of that. And I tried to take the other side of it for a second. I was like, well, let's think about this. The dollar's been coming down, yields have been coming down, commodity prices have been coming down. Maybe that's really good for S&P earnings. So thoughts on that idea here, because it almost looks better positioned for that too, if you think about it.
With some delay, eventually it's better, but I think it's more of a sort of symptom. For instance, for commodities, a risk of economy being slowed down, right? Dollar going down, it's really mostly against euro rally on this announcement. That was like, I think 3-4% in a 24 hours move. Yeah, on a margin, it does help earnings, but like, hey, if like a Canadian start removing U.S. products from shelves, if Europeans do the same, it's not going to help the dollar is weaker, right? If they slap you 25% tariff or worse, they actually say we're not going to sell your product at all. 5% weaker dollar is not going to make a difference. So yeah, on the margins, if it stays that way and things normalize. It's eventually better, but I think now it's more of a symptom of worse things to come, or bigger risk, or bigger imbalances, bigger geopolitical sort of tensions and flux, which is generally not good, I think, for all businesses, across the world.
Let's talk about that for a second, because what's interesting to me about this time around, Trump 1.0, they really were focused on China at first, but then they started targeting, like steel and some other stuff with our trading partners, right? And, right now, when I think about geopolitics, so let's just talk about the EU. Let's talk about our wavering commitment to NATO. Let's talk about a shooting war war, obviously in Ukraine, which the president refuses to admit that the Russians did not start, and he's trying to kind of negotiate some sort of ceasefire without Ukrainians' involvement, right? So that has emboldened the EU. They are, for the first time maybe in a long time, which there's a certain sense of irony because Trump has railed against NATO's spending by the EU for a very long time, and they're doing it now. But let's just say those geopolitical tensions from the EU, from Canada, from Mexico, let's just say that we get stuck here. You know what I mean? Like that, so you have a few different things. You have, geopolitical tensions, you have economic tensions. There's a whole host of other tensions. I got an email from one of our listeners, today, who's a Canadian. He's like, when I tell you I'm dropping all of my subscriptions to U.S. companies, I'm not buying U.S. products, Canadians hate America right now, which is insane for us to think. Canadians are the nicest people on the planet.
It's like, it's bizarre, right? Yeah. It's bizarre. I mean, let's start with the Canada, right? Yeah. This talk about basically making Canada 51st century, basically abolishing Canada as a country, right? It's a kind of bizarre, right? And I was for a long time struggling: is it a joke? Is it a negotiation tactic? Is there actually real attempt to do something like that, right? But let's say if it's a negotiation tactic, what kind of negotiation tactic is that? Like, so let's say I'm like asking for promotion, right? And I go and I start cursing you, right? I say like, whatever, I'll kill you or something like that. It's not a negotiation tactic. It's not going to do well in any way for me, right? Now you can say, well, he has an upper hand over Canada, right? So he can do that. But again, what's the point, right? Like, I mean, yeah, if you want to actually roll the armor division in Canada and take it over, just do it. Like, what's the point of offending them and insulting them, right? I don't get it, right? But it's certainly not something that I think helps sentiment, right? Or helps even that negotiation process, right? So it's a little bizarre, right? Now if you look at the European Union, like, European Union, as you said, like, yeah, they rallied. Like, I'm not convinced that that's also a good thing overall for Europe or for the world. Like, and let me tell you, people now say, okay, they'll spend in the next 10 years, trillion euros, and they're gonna there's gonna be a lot of gravy around, a lot of sort of green energy and weapons, green energy mixed up with weapons and stuff like that, right? But reality is, like, look at the Germans election, like, youth, like 18 to 25-year-old Germans, they either vote AfD or communists left, right? That's going to be so like, who knows what may happen in 3 or 4 years in Germany, right? It might, as the best might be like internal crisis political between right, like back like in 1920s, right? So I'm not buying that like Europe is set for the next 10 years, right? So that's even like within countries, right? And Germany is not the only one. But now look between the countries. I mean, look at the Hungary, look at the Slovakia, look at the Romania. What's happening in Romania? Like, there's a candidate who's a pro-Russian candidate who's got banned. There's another one who's also he got banned as well. It's not going to end up well. Europe doesn't have cohesion between countries. And even within countries, they don't have a cohesion, right? Like, so for me to think that somehow Europe now is the leader of a free world for next 10 years, I just don't buy it. And I come from there. I have passport as well. So it's crazy, right? And Trump on the other side is basically saying, sort of, you guys created European Union just to screw over Europe and US and stuff like that, right? Like, so it's not a good dynamics, and it didn't really start. We'll see. I mean, we saw a little bit with alcohol, with spirits, right? The France wine, but we'll see it in a few weeks, right? And then Russia and Ukraine, I'm also scratching my head a little bit, but there is some thought that is coming to my mind. Look, Trump clearly has some affinity towards Putin, towards his style, and I'm not saying this in any kind of like condescending way. It's just a fact. I'm just stating a fact, right? So he probably believes that kind of might is right. And again, not going into history of a problem of, let's say, Crimea, right? It's a very complicated history. It's not black and white. But he thinks might is right, and I'm going to take it, right? And look, Trump might do that to Greenland. Again, he said yesterday or day before, he said, hey, look, some ships came there 200 years ago and it's not even sure they came and blah, 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 blah. So he might actually strike some deal with Putin and say, hey, look, this is a new world order. This is a new philosophy. Might is right. You have your own sphere of influence. I'll have my own sphere of influence. I'll kind of circle around North American continent, including Greenland, and you circle your Eastern Europe. And if you want Moldova, take Moldova. If you want Baltics, maybe take Baltics as well, right? So it's not clear. I'm not saying maybe it's a crazy negotiating tactic. Like, you have this I'll make it sound really dumb, right? Like you have like a drunk guy in a bar who wants to pick up the fight, and then he takes like a ball and breaks on his head, right? He said, hey, I'm crazy. Who's gonna touch me, right? So maybe it's that type of negotiating tactic, but maybe it's not. So in any case, we live in a world of uncertainty, so I don't find appropriate European stocks rallying 20% on that. Like, it just feels also a little bit weird.
So are you inclined now to take the other side? You just mentioned that you don't think it's appropriate. So we've run too far, too fast. Also in China, as far as equities are concerned? Yeah, on both. And so would you favor now if we were to go back towards 5,500? And I think in the interview that you did maybe a week or two ago, I think it was March 11th with Bloomberg, you suggested that if we were to go recession, we go through 5,000 and we probably have somewhere with a 4 handle on it. So let's just talk about the things that kind of get the market sniffing that out. Okay, so right now we have an S&P again that went down 10%. The Nasdaq was down 13%. Let's talk about S&P 500 earnings. Coming into the year, they were meant to be up 13, 14% or so. That was consensus. That's come down a bit over the last, call it 2 months or so. So here we are having an S&P with, let's say, consensus EPS at $270. That puts you at current levels. Does that sound about right? At about 21 times or so. Again, people only start talking about valuation when the markets start heading lower. Where do you think the S&P, assuming that this generative AI CapEx boom, doesn't get hit dramatically hard in a slowing economy, where should the S&P 500 multiple kind of bottom out if you go back to 2022 and think about that as a bit of a guide? So first on the CapEx, I do think CapEx will be cut a little bit. That's my view. But where the multiple should bottom, you can look at sort of historics and see where where historically that could be, and that could be like 16, 17, even without recession, right? That could be some just a lot of hair in the sentiment, right? So that could be the multiple, right? So that's why I think S&P could go to 5,000 relatively easily, right? Relatively easily. Now, Europe is, I don't want to say all-time highs, but let's say recent all-time highs, right? Same thing as China, right? I mean, there are points in time when China tech was trading higher, but these are not anymore times. And I think if you look at the last 4 years, it's at all-time highs, right? So I don't think that Alibaba should be trading at $150, up 100% from 70 to 150, right? In a few months, right? I think that's nuts, and most of it's just a multiple re-rating, or same thing for DAX. Because if there is no recession, the rally there played out, and then US can catch up. Like, you can have some of the things that derated may rally from here 10% or so, right? Go back to where they were, right? If there is a recession, then I think, yeah, sure, US will go down, but then these foreign markets will also need to acknowledge there's a recession, right? So that's why I do think that probably trade is here, that you fade the rally internationally. If you want to the extent you feel positive about no recession, you may then buy US here at 55. If you do think there is a recession, I do think S&P will probably go lower to, like, call it around 5,000, right? Or significant hit on earnings, right? So I think it's the balance. The fact that, let's say, China tech rallied like 30% and US Nasdaq dropped like, call it 15%. So this gap, like, call it 40, 45%. I would play the reversal of that gap. It's just not clear. Do you want to be net short? Do you be net neutral? Or you want to be net long Nasdaq here and over these? So I do think that trade is starting to set up now. It's called 55. We are basically playing, okay, if there is a recession, these things will tank. If there's no recession, Nasdaq will rally, and this thing already rallied so much by various metrics that it's probably sort of topping out somewhere here. So
on that recession, right? Because people say, well, isn't the whole point the world is being deglobalized now, right? Maybe that's a sort of end goal, but Trump started deglobalizing the world like 2 weeks ago, right? So the world is actually very much global still, right? So I think it's illusion to think that suddenly US will go in recession, but Europe will do extremely well, right? Again, like if Trump kind of deglobalized the world 5 years forward, maybe that's going to be the case. But right now, we still have the world as it was 2 weeks ago, right? Yeah. Or 3 weeks ago, right? Like, which is very much global world. So if US get in recession, Europe is going to go in recession,
Yeah. So you've probably been asked this 1,000 times over a couple decades. What do you think the probability of a recession is?
Yeah.
Now, I'm not going to ask you that, and I'll tell you why. Because over those last 2 decades, I can't remember a time where the future was so uncertain. And I want to make one point about that, because you just suggested this deglobalization that's just become a thing over the last month or so. For Scott Bessent, and let's say there's some like brain trust within the administration that agrees about the detox and really wants to reset, the stage from a deficit standpoint here and figure out how to do that, and then basically have better engagement with the globe on a trade perspective. It can't be done. I mean, this has to be bipartisan. It has to be something where both parties come together and they convince their constituents that this is going to be a 10 to 15 to 20 year sort of thing, right? So when you hear about this all in the near term, the market's going to have some problems, the economy, it's going to be a transition. I just don't buy any of it, because it can't just be one party, because this party is likely to lose the House in a year and a half. And then you say to yourself, nothing gets done again.
Yeah. No, 100% agree. I would even, again, take it a step further, or maybe, make it even more sort of with this Canada 51st state, right? Like, yeah, get a Canada 51st state, and then next election, they're going to return back Canada and apologize for it, right? Like, so you need to have a little bit of, as you said, consensus if you want things to stick and not revert back or not get a backlash. So yeah, it's chaotic, right? It's a little bit chaotic. And look, I think 10% drop in S&P probably reflects some of that chaos. It doesn't reflect yet recession. It's a world environment which is highly, I would say, uncertain, right? And Trump won. It was a little bit different, right? And we talked here in November, but difference of Trump 1.0, 2.0, right? Now this is a little bit different. Its risks are higher, and yeah, I don't recall. I mean, look, COVID was a period of uncertainty, right? When you didn't know what's going to happen. Like, is this real? Is it not real? Are we going to die? Are we going to be just fine? Are we going to reopen? Not reopen? Like, so I think there was a lot of uncertainty there for a few months, right? Like, so I would say there were probably worse uncertainty now, but this is probably second biggest uncertainty now. Call it, GFC 2008. A lot of uncertainty as well, right? But I would say, like, okay, GFC, COVID, and this now, it's somewhat comparable, right? The level of uncertainty, and that's why one needs to be, I think, careful, sort of jumping in with both, foot in the markets right now, and then especially, again, I find it very bizarre, people buying Alibaba today up 5%, right? Like, as like, China is our new best friend and they're going to do just well, like, fine. So I think there's complacency. There's complacency still.
What are a couple metrics that you would kind of suggest to our listeners that they focus on if they are, as you are, as I am, uncertain about the path of our economy and worried about the potential for a recession? If you think about austerity and Doge, and you think about uncertainty around trade and tariffs, that sort of thing, what are a couple things that you are tracking that would lead you to believe, and I'm assuming we haven't even talked about employment, what are some of the things that folks could keep a close eye on that could kind of give them a sense that that the economy is weakening in a meaningful fashion?
Yeah, I mean, look, employment, I think looks not too far. In a few weeks, we will start to have earnings, Q1 earnings. Some of these sentiment indicators are definitely needs to be watched, as they are a little bit now partisan in some ways, so it's not as clear. And tracking the layoffs, the job cuts and those type of things, from the sort of macro fundamental side, and then on this kind of geopolitical side, Look, it is not impossible that Trump basically goes, and I don't think it's not my base case, but it's possible that he say, hey, look, I think we're going to have a great deal with Europe. We're going to have a great deal with Canada, right? He's not going to do it with China, but with Europe and Canada and Mexico, he should be able to do that, right? Because you can't fight this thing kind of alone against everyone, right? You need to at least have someone on your side, right? So if he would say, hey, look, we're going to resolve issues with Canada, we're going to resolve issues with Europe, right? So far, not looking like that, but, one could develop some level of optimism, because then if the world can somewhat, take a similar position and then negotiate with China, maybe that can be sort of muddled through without recession. So I would kind of look at that rhetorics. Maybe he does come on April 2nd and is suddenly a lot more conciliatory towards at least call it our allies or former allies.
All right, so that solves possibly the market problem,
yeah,
but it doesn't solve the economic problem. So I guess my question is what is the things in which you could foresee to cause the U.S. economy to inflect higher? Because again, we look at GDP last year, it was better than expected. I think consensus was like 2.5%. It might come in 2.8, 2.9 or something, but now it's expected to be a bit lower than that. And so I'm just curious, are there a scenario where we could just see growth accelerate?
Hard for me to see that.
Yeah.
Hard for me to see that because it's going to be less government spending or maybe same amount, but it's definitely not going to be more. It's hard for me to see more governments. People question how much of this Dodge thing actually is real, how much is not real, but I think it's going to be less government spending, not clear how much, but less, right? Yields are where they are, right? Mortgages are where they are, credit cards are where they are, right? So that's not getting better, right? And then look, I mean, you saw those job cuts, they kind of triple, fine. 1/3 was a government employees, so it's actually Dodge thing is a little bit real, but the 2/3 were not, right? So that's not, I don't see that getting better, right? I can see stabilizing or getting worse, right? And then the whole CapEx, again, I think people got burned. People thought NVIDIA is just going to go through the roof. Palantir is just going to go through the roof. Now they got burned, right? So now that, hey, look, maybe they're not going to, maybe they're not, right? And I think these people are smart. The CEOs like a Microsoft, they'll say, hey, look, we're going into this uncertainty. Do I really need this extra data center there? Why don't I actually pause? Why just a pause until this kind of air clears out, right? So there, I don't see even better, right? So I don't see a scenario where things get again, people do far-fetch. I don't believe it in either, but people say, well, in China is going to get better, right? Or in Europe is going to get better. So, but that's such a stretch. I mean, you're responding, China and Europe are responding to bad situation, right? So in my view, that will just maybe stabilize situation rather than dramatically improve it, right? But in US, you don't have even that, right? You don't have even some hope. So a lot of talk yesterday from China, right? I don't know, 30 points or something. We're going to do this and this and that and that, and no numbers attached. A lot of talk, right? So even there, I think you have a lot of talk. Not really. It remains to be seen. Does it really translate into something? But US, you don't even have a talk, right? They just say, hey, look, we are okay with things being kind of, slowing down, right?
So it's interesting you mentioned NVIDIA. So by the time folks are listening to this, it'll be Tuesday. And tonight, Tuesday, Jensen Huang, the CEO of NVIDIA, is going to be doing the keynote at their GTC, their big user conference. And it's interesting to me because we have that on Tuesday and then we have the Fed on Wednesday. And I'm hard pressed to think which one is going to be more significant because to me, the way, and they're obviously saved something from their earnings or a handful of things. We know how companies are meant to do this, that they're going to say a lot of positive stuff. They're going to map out the roadmap, you know what I mean? That sort of thing. And if the stock can't rally after that would make me very nervous. So speak to, again, let's finish up this conversation on concentration of the Mag 7 because the trade is stalled out. And if it can't rally on a good quarter and guidance by NVIDIA from February 26 and then on whatever they say here, then you have to say to yourself, the trade is probably in the toilet for a bit.
Look, I was always a bit cynical about NVIDIA, and that may be my bias. I'm not an NVIDIA analyst, but the issues there are, if we go in this environment of corporates being a bit more sort of cautious about what's going on in the world, I think that translates into less CapEx, right? I think if you go in a trade war, I mean, all these NVIDIA trading via Singapore to China and those type of things, if we go in a more strict trade war, I think there you also had you had issues. I mean, stock has rallied sort of now a little bit, right? Like, from
15% off the lows.
So it's not sort of quite, it's, clearly it's not as expensive as before. But that's all conditional also on the level of growth, inflection of growth.
Nobody believes that CapEx could be cut by the hyperscalers and Meta, which is fascinating to me. It makes me, and I know you're a contrarian, as a contrarian, I almost want to take the other side of that, because I go back to, in 2022, at the lows in October, the S&P was down, 25%. The NASDAQ was down 37 or so percent. And NVIDIA and Tesla and Meta and Netflix, they were all down 70% at their lows. Think of that. That's insane, right? But it wasn't until we started seeing those companies cut costs, like Meta, where they bottomed out. And so that would be the equivalent. They've already culled down their numbers since COVID dramatically. So the equivalent now would be cutting CapEx.
Yes. Yeah, that saved like Meta, right? Meta went to what, $100, $200, right? And then rallied to 700 when they say, okay, we're not going to waste any more money on this, right? Now, if you go back to that recession risk, and I'm not saying recession yes or no, just probability going higher, right? If probability of going higher, it's going to be less advertising, right? So you have like Meta, you have Google, right? It's going to be also less, or it's going to be delayed CapEx, okay? Might be more redirected to buybacks if there's a pullback in stocks, right? And those type of things, right? So all of these things on the margin tell me that probably there should be less or more cautious. And at some point, market may actually start rewarding. Up until last year, January this year, market was rewarding, hey, we're going to spend so much money. Great, please do spend, because this whole thing, I mean, I heard it so many times, you need to spend because you don't want to left behind, because you're left behind, there's no way you can catch up, right? So you need to be spending like a drunken sailor, so for the future that you can even grow even a lot more, right? Like it's a lot of it was, to me, sounded like a little bit sales pitch, NVIDIA sales pitch, right? Now I think companies might start at least be neutral if they say, hey, we're going to be a little bit prudent with our cash, or if things really turn ugly, they'll be rewarded for actually.
Yeah, so they wanted to ask for forgiveness, not for permission from their shareholders. And it is amazing that Google, Amazon, Microsoft, and Meta were all trading at all-time highs into their earnings reports. This is late January, early February. All of them raised CapEx to a point that should have been, or maybe 6 months or a year earlier, you would have had investors cheering that, but they had a deceleration in revenue growth, and they had an acceleration in CapEx, and that was it. And now they're all down 20% or so. Listen, Marko, you and I could do this all day. I know that you probably have more important people to sit down next to than me, but I really appreciate
just my kids, no?
Yeah, well, that is much more important than me. I appreciate you coming back. I hope we'll do it again really soon.
Thank you so much, Dan.
Thanks.
It's always great to be here.